I'm your host, Josh Appelman, founder and CEO of Appelman Properties and Real Estate Hustlers podcast host. Today, we're going to find properties in Loopnet and see if we can find a deal or a trap. By trap, I mean it's priced too high, and the only way to figure this out would be to do proper underwriting and find out what the proper price would be for it to be a good investment. Why learn how to invest in real estate now? The market's changing. It's changing fast with interest rates. We see cap rate compression starting to ease up. We see seller expectations easing up. Buyer expectations are going down. So we're in the middle of the transition. We're going from a market shift, and we want to be able to capitalize on the market shift as investors, not necessarily taking advantage of people, but taking advantage of the market cycle. So I'm going to go through some tools. Let me get my screen share up here. I'm going to go through some tools that I use to underwrite. Bear with me 1 second. Let me know when you can see. Do you see prop stream up right now? Okay. All right. Yeah. So prop stream, I use this to pull up the property information. We can pull up mortgage information, see how much is owed on the property, see how much they've taken out, so we can get a better understanding of how much we have to play with. So if they're asking $2 million for the property, and we know that they've got $1 million loan outstanding on it, we know that we've got a delta between purchase price and what we can offer. Property tax calculator. So this is not a solution to find out exactly what the property taxes are going to go to after the purchase, but it's going to give us a good idea. So as I do an underwriting, let's just say my zip code 41018, and we're going to buy it for $2 million. New property taxes would be around $22,600 annually. This is not a this is just to get us a high level guesstimate on how much the new taxes are going to be, but you still need to go to the property, the county assessor's website, and find out what it's exactly going to be for your numbers. I use Zumper to get the rental rates of what the comps are going to be. So if we know that we can push rental rates up to a certain amount, I'm going to go on here and verify. I'm going to see what the current listings are. And these are still on the market right now, so it doesn't necessarily mean that these rents are going to be able to be pushed this high, because these aren't leased. So right now there's a housing demand, and these are still sitting on the market vacant. Let's say where the rental rates possibly are decreasing. City data. So I'm going to go on here and find out just the market, what the area household income is going to be, possibly crime rates. That's extremely important. Find out the crime of the zip code and where the property's at, and get a better understanding of the location, especially if you're investing out of your area, and you want to make sure it's not going to be a problem property. And then Loopnet. So I'll go ahead and get we'll get our property selected here. I'm gonna go in Cincinnati, and I'm out of northern Kentucky, right outside of Cincinnati. Jack, I just muted you just so we can, and just let me know if you need to be unmuted. All right, let's go through some properties here. We've got, and another thing, don't be the price of the property. It doesn't bother me as far as $4,512,000. I look to see if the properties are actually going to cover this price. So that's the big thing as investors. This is like saying it's too big, too much. That part doesn't matter if the properties are performing. One thing I'll say about this is these are multiple properties, accumulation of properties. It's going to be a ton of work underwriting this. We got 17 off-market properties in Clifton, so every one of these properties needs to be underwritten separately, because you're going to have different taxes on each property. You're going to have different capex, meaning how much renovation is going to cost in each one of them. It's just a lot more work than what I would choose to do on underwriting. I would accumulate these properties one by one, but not necessarily look to take down a portfolio of this size. I would rather have 2 roofs, apartment building versus all those roofs, 17 properties. Let's see here. 14 units. Let's see, 1.1. And what I need from Loopnet, I need the price, and then I need a rent roll and expenses. So let's see here. 23 parking spots. Amenities, property is common area, laundry room. Property is also on a bus line. That's something, that's a positive, depending on the class. So this is a C class, I wouldn't say a C plus, but that's workforce housing. So we want to make sure that the bus line, they're close to transportation. Property's been well maintained, professional management. 3-bedroom units, 1,100, 1,200, 900 to 1,000 for 2 bedrooms. Let's see here, gross annual income, $132,000. Other income, that's probably the laundry, vacancy loss. Let's go into we'll keep this one up. We'll see if we can come back to it. See if we can find a bigger one here. And I say bigger, the more units you have when you're buying investment multifamily, the better off the cash flow is going to be. It's economies of scale. Let's see, 29 units, it doesn't have a price. So we can underwrite it and we can offer a price, but it doesn't mean that's going to get accepted. So we know what expectations are if they're already saying the price. Let's go in and go to one more page here. I'm familiar with that portfolio. It's they bought it in 2020, renovated them, and they're looking to sell. So that's what we're seeing with a lot of properties that these syndication teams have bought within the past year and a half. Is they took out bridge debt, and that bridge debt needs to be refinanced short term. And they bought based on pro forma, meaning the property needs to perform to pull them out of positive or negative cash flow. So there's going to be a huge opportunity with multifamily coming up on the horizon. Let's go into the, let's see here, not that one. Now let's do our, let's see if we can get data room. See what kind of financials we can pull from this. Taxes. I don't know if we're gonna have anything different than what they've already given us. All right, well, we'll put in the information that we've got. So the Excel sheet that I use, we put in all the information, and then we're gonna find out exactly how much this thing's worth and how much we can get away with. I've got one more coming in here. Okay, can you all see my screen, the Excel model?
Yeah.
Okay, all right, perfect. So I'll just put in the property name. We'll just 3517-3519 Woodbine Avenue. I'm not worried about this. We'll just do this for today. Number of units that'll self-populate. So they're wanting 1195. Offer price, we're going to say we're going to match it until we find out how much we can truly afford. Okay. And then unit mix. So let me see if I can take this over here. I'm going to have to switch between tabs. I don't know if it tells me exactly how many units they have of, let's see, we know we've got 14 units. Do we know if we've got 14 units of 1, 2, or 3 bedrooms? Let's see here. If not, we've got to make assumptions. Let's see, 2 and 3 bedroom units. They're claiming value add opportunity rents 300 below market value. Okay. All right, so we'll do a conservative unit mix just to make sure we're not shooting ourselves in the foot here. Two bedrooms and then three. Typically your 1, 2, and 3 all have one bath, which it does make a difference, but and then let's say 4. And so we've got 5 1-bedroom units, 5 2-bedroom units, and then 4 3-bedroom units. And that can drastically change, of course. 11, 1200. Let me read this one more time. 2 and 3-bedroom units. Sorry, there are no 1-bedroom units according to their. So we'll just split it in half.
Josh, are you a broker?
I'm a real estate investor, so I've been in
Oh,
business.
cool.
Yeah. So we buy properties. We've been holding off on multifamily. We closed on 48 units earlier this year, but we've been really holding off remainder of the year because of market conditions, knowing where things are heading.
I understand.
So you're getting the investor perspective of purchasing. What is 7 and 7? 0. And I don't think it's telling us the square footage. So this information is very bleak. We're just doing a broad overview. Jack, I'm going to go ahead and mute you, buddy. Square footage. It's going to say 700. That's the 8. The small one. And then 3 bedrooms, we're going to say 100. Current rents. We're going to say is that 2 bedrooms, 750. 3 bedrooms, we're going to say 950. And then they're claiming 2 bedrooms. So usually you'd have a rent roll in front of you. This information, I mean, we're just doing a high level here. 1100, 1200, and then 900 to 1000. Say 900 on the 2 bedroom, and then 1100 on the 3 bedroom. And I'm performing this out for 5 years. Let's see where we end up at. And I'm not giving us any kind of rent increase. Just want to see where we're at now and where we're going to be at within a year. So there was additional income here. Let's check this out. Additional income, that's going to be from the laundry. So 2,900 a year. Vacancy 3,960. And 29. 60 on the vacancy. There is always concessions and bad debts, and that's from people who just don't pay their rent, and then you have to end up evicting them out. And let's see on a property like this, we'll hold that off to the pro forma. That was 2,900 for laundry income. Rubs, so that's where you would bill back the utilities back to the tenants. So their water, typically your water and sanitation is all master metered on the building. So you would bill that back, say $20 per month or $15 per month to the tenant. And then even electric, if the electric's master metered, you can bill that back to the tenant on a monthly basis too. In this case, it doesn't look like it's being done, but we can put that in our pro forma. Just say we're gonna do $10 a month, or well, we'll do 2,900 on laundry. And then let's just say we're gonna do $30 a month for electric and water and sewage. And that should be 5%. They're actually lower. That's unrealistic. Oh, 0.02. You're typically going to underwrite at least 5% vacancy on the per year. They're right at 2%, and we're going to say at least 5% because we're wanting to be conservative on our end. All right, so let's go over to. Let's get these filled out. 5 years. We're going to keep the laundry right where it's at. I don't want to count on that extra income to increase the value of the property. Okay, evaluation. All right, so they're asking 1.195. Closing costs, that's typical 3%. Acquisition fee. So if we were a syndication group, we're going to charge at least a 3% acquisition fee to bring this to the investors. And but we're also promising that the property is going to be performing and our business plan is going to be executed, and we're going to increase the value of the dollar. So in this case, we're just doing this on our own. CapEx per unit. So we're going to assume that we walk through each unit and they're all in original condition, and we're going to have to have new flooring, new paint, new hardware, cabinetry, possibly new plumbing fixtures. Countertops typically are going to need replaced, which we go back with granite on all of ours. Typically new toilets, new bathroom surrounds, new blinds. So we're going to assume that we're going to need to put all these things in here to get this thing to perform to the new market rate rent. Jack, you got a question? Okay. So we're going to do, let's just assume on a low level, if we're going to do all cosmetic, do 140,000. So that would be labor and material for the renovation crews. It's heavy, but it's light, so it's conservative. We could come in more or less. Okay, so we've got initial cash in 239,000, total equity investment 414,000. That's including the CapEx. So our total investment going in is 1.37. Loan amount, that's going to be based on an 80% loan to value. That can still probably get done these days. Let's see, first loan, interest only period. So the days of the bridge loan are tough right now. They were very cheap. They were easy to get done. Bridge loan is temporary debt, temporary financing, meaning we're going to purchase the property. We're going to have interest only period for say 2 years with 2 options to extend. And then we're going to refinance into long-term debt. It can still get done. Interest rates are not going to be at 6.75. So we're going to say right now 8.5, which that's changing every month. Monthly interest only payment is at 6,772. And again, this doesn't bother me as long as the property is producing and it's covering it nut, plus it's bringing back money, new money home. So annual is 81,000. monthly principal and interest after or if we were not to refinance, be 7,351. Over here, we've got a refinance after 2 years. That's if everything goes right, interest rates, market conditions. There's a lot that goes into it. And we can also say that the refinance cap rate is going to be lower or higher. It depends on the compression. Right now, I'd say 7% would be middle of the road, especially for this property. And let's just do actually 8%. We're in Cincinnati here. So let's see if, and we're saying the property, the valuation would be around 2 million at the 2-year mark. So let's go down here and get our expenses in. So accounting, let's do, we're talking the tax returns, just general bookkeeping. We're just going to say on the low side, 500, admin, 1,400, and these are annual. Advertising, so we got to fill the units. There's a lot of different ways to advertise. On my end, I'm not going to put anything in here because there's a lot of ways of advertising these buildings for free to get them filled up. Legal, we'll say 300, just in case of any evictions. Let me get back here to see what they've got in for theirs. They did have that higher. Taxes 14,244. Put that in here. And they didn't have legal on their end. We're going to put legal on our side. This is the right side is the pro forma. They're saying that their expenses, according to this, are a little cheaper, which that's normal. Operating expenses 52,649. I'm going to put that in one big bucket down here. Do that one more time. See what else we've got. Change this number here. Valuation. All right, let's see what they have for insurance, if anything. It's probably under the operating expenses. Okay. And okay, so they're at 47%. That's actually pretty close to what I would do. I'm usually at 50% from gross rental income to expenses. And let's figure out our new taxes. So they're at 14,244, and let's go to our get the zip code 45211. Okay, so we're going to be at 21,152. So it goes from 14 to 21. Okay, we're going to keep the same expenses that they had. And see, we're at 46. So I want to add.
Hey, Josh,
Yes. Yes.
quick question. Hope I'm not interrupting.
You're fine.
Can you hear me?
Jack, are you with me?
Never.
Okay, all right. Okay, so we want to get more expenses in here. I want to get closer to the 50% mark just because we're conservative. We want to make sure that we're good. Add 3,000 there. And again, these are just high level numbers. We just want to see where we're at before we contact a broker and then get more information. Okay, we're at 50%. That's where I want to be on my end. Asset management fee, we're going to say 0. Asset management fee would be a fee that we charge as a syndication firm to the investors for managing the performance of the asset. So we want to make sure that things are going according to the business plan. That takes time, effort, and responsibility. Okay, so here's where we are at out of the gates. Let me just look over the expenses again. So we have real estate taxes and then the expenses they gave us. Let's see here. And total expenses 66,000. We're at 66,893. Vacancy. We're at 66,893.
I just see now you were muted the whole time. I was like, wow, he's just going away working at the site. Sorry.
I was
I had
muted.
a question. Do you
Yeah.
underwrite trailer park deals somewhat differently? Or? I just see now you were muted the whole time. I was like, wow, he's just going away.
Jack, we got feedback from your side.
I had a question. Do you underwrite?
Okay. Jack, I have to I'll give you a follow-up call on trailer parks, but yes, they get underwritten differently. You've got you don't necessarily have the same type of expenses because you're renting the trailer or the lots. But I'll follow up with you here. Okay, so we've got close to the same expenses. We're net operating income 74,809. Let's see where our cash flow ends up at. So we're saying based on their underwriting, based on projected rentals that they're currently receiving, we're at negative 13,401 just by purchasing the property. So then we've got to raise the rents, which we raised the rents over here from 750 to 900, from 950 to 1100. So we've raised the rents to market rate. And we're still at a negative $7,681 per year. So surface, this looks like this could be a buying a bill. As an investor, you got negative cash flow returns. Your cap rate is return is low. Your DSCR, debt service coverage ratio, wouldn't work for any bank, even on the buy-in. So this is not looking like a deal. It's looking like a trap. This is just high level, but it's where we're at right now. And then the cap rate, property value. So a $935,000 go-in price would be where we could make an offer. Let's see what that changes things out to. Let's check our. Okay, that just put us into a positive of 5,791, and then on a pro forma 11,511. If we were to buy this property, renovate each unit, and raise the rents. So then it goes into risk reward. Is is that going to be enough to make us feel like we've spent our time wisely? And I don't know. That's going to be up to you all, as far as how many units you want to take, and then the amount of effort, amount of energy. Because in these, you are buying a business, you're buying liability. You've got a bank note you've got to pay back, possibly investors. So everyone's looking for a return. You want to make sure the return's solid. I always overestimate on expenses, and it's worked out for me on the deals that we've purchased, because now I can figure out creative ways of lowering those expenses and keeping more cash in the company and the apartment complex itself. But this is what we do on a deal by deal to see if it works, see where we can add money to, like the rubs, filling back the utilities, and then going in and seeing what if we can increase the laundry income as well as storage units that are on the property, if we can get those leased up by the tenants. But if anyone's got any questions out there, you can always just direct message me. I'm here to help any way I can. I think it's extremely important to get into real estate and start investing into hard assets, put cash in bricks, they say, just because you can feel it, you can touch it, and you can leverage it in a lot of different ways. And one thing that's certain is not going to go away is real estate now or in the future. So that's what I've got. And see if I've got any other questions here. That's it. All right, guys, make sure to get a hold of me if you need anything, and definitely appreciate it. And we will talk soon.